The European Banking Union is meant to ensure financial stability in the EU, but after 3 years of work there's still one final piece missing in the banking union, and that is a common system of deposit guarantee. Now most EU member states agree that we need to move towards such a common system, but what they don't agree on is how to get there. The financial crisis and the failure of large banks triggered the EU to start working on a banking union in 2012. The overall aim has been to separate banks from states and make sure that taxpayers don't have to bail out banks. Instead, there will be a bail-in, which means that creditors will have to take the hit if a bank falls. With this in mind, the European Central Bank (ECB) took over the supervision of European banks last year. And as of January next year, there will also be a resolution mechanism in place in order to close down or restructure troubled banks in an orderly manner. The last pillar in the banking union, which is still missing, is a common system of deposit guarantee. The European Commission proposed such a scheme in November under the name EDIS, European Deposit Insurance Scheme, and this week EU finance ministers had a first discussion on the matter. Some wants to go ahead swiftly. Others argue, however, that before member states start to share risks in the European banking system, the risks have to come down. Especially Germany, who has the biggest wallet in the EU, is concerned of the classic problem of moral hazard.
I think we should start with reducing the risk in the banking sector before we concentrate on additional risk sharing. Risk sharing is always an obstacle for risk avoiding.
The German minister also argued that the scheme cannot be built within the EU regulations, and he said frankly that he was ready to take the matter to the EU court if needed. In the European Commission, which is the designer behind EDIS, they say that they are ready to discuss the way forward in order to get all member states on board. However, they don't see any major problem with moral hazard.
There'll be no free rides. We have built in, I think, strong safeguards against moral hazard. No money out of EDIS unless you first paid your full contribution to your national DGS. And during the reinsurance phase, no money out of EDIS until all the money in your national DGS has been paid out.
Jonathan Hill also said that the reduction and sharing of risks should not be done in any specific order, but be done simultaneously. And he got support for that position from some ministers around the table, such as the French finance minister Michel Sapin. Guntram Wolff, director at the economic think tank Bruegel, thinks that if you do have supervision and restructuring of banks on EU level, there has to be also a European deposit insurance. But at the same time, he sees problems with sharing of risks.
We know that there's significant national policies, for example, as regards the treatment of mortgages, that influence the profitability of banks, and that is really where the moral hazard comes from. So you still have national policies that influence bank profitability, and therefore there is a moral hazard issue indeed.
Guntram Wolff thinks that Germany will eventually accept the insurance scheme and to share the risks in European banks, as it is a crucial part of the banking union as such. The European Deposit Insurance Scheme is all about making sure that at least part of the money that you have in the bank is secure if the bank goes bust, and that it is secured within a European system. But even with this third and final pillar in the banking union in place, it may not be enough to handle a crisis in a big bank. In fact, taxpayers and states may still not be off the hook.
In big systemic crisis, so be it one big bank or several medium-sized banks, the application of this bail-in rule will be watered down, because you cannot bail in 8% of a major bank in a systemic crisis, and at that stage we will need taxpayers' money.